Hey guys, it's Lauren Keim here, and I really apologize for all the technical difficulties we went through today. I have never had that kind of problem, and I've been doing this for years, so I, again, really apologize. I'm going to start today by going through the third segment of our fundamentals program, and I'm going to break these into sections 3, 4, and 5. And that's about evaluating the investment value or the investment potential of commercial investment real estate. And certainly you've heard the term cap rate, gross rent multiplier, cash on cash return, or return on investment. But what do they really mean, and how does a professional commercial realtor or an investment advisor or even an investor determine what a property's worth? So we're going to discuss the various methods of valuing commercial investment real estate today, and then we're going to introduce you to the concept of financial analysis for real estate. Again, this part is not nearly as fun or entertaining as marketing property, as listing presentations, or even prospecting, but understanding the numbers, the returns, the income streams is vital. It's central to commercial and investment real estate. We're going to be exploring some mathematical formulas today. Yay! And normally when I start talking about financial analysis, I have to duct tape my head so that if it explodes, all the pieces stay together. But basic financial analysis isn't as challenging as you might think. As I said earlier today, the author of The Psychology of Winning, the brilliant Dr. Dennis Waitley, wrote that there never was a winner who wasn't a beginner. And as I mentioned in day one, commercial and investment real estate math looks complicated, but stick with me and you'll learn it. As I mentioned yesterday, all commercial real estate is an investment, although some buyers of commercial property use that property for their small business or their personal use, and other buyers are strictly investors looking for a return. Both consider the property to be an investment. Now, entire courses exist on real estate investment analysis. Our goal today in this workshop is to introduce you to the concept of income and cash flows, the primary methods of calculating return on investment, and how they are important to property valuation and the marketing and sale of commercial real estate. We're going to outline the various forms of calculating returns on investment and the property valuation based on those rates of return, but an in-depth analysis of income projection is going to be in an advanced program. So let me start by explaining how we value commercial real estate and why investors use so many different methods and terms. Now, an appraiser is supposed to be the arbiter of value of any transaction, right? Well, this is one of my favorite appraisers. His name's Wassel. And Wassel would say that an appraiser is an impartial third party who bases their evaluation of a particular piece of real estate on something called the fair market value. And this appraised value, or this fair market value, is supposed to be based on the most probable price a property will sell for, that's a mouthful, in an open market. And the market value of that property might be higher or lower to a particular buyer based on their circumstances. An appraiser estimates the value of the property based on a combination of comparable sales, comparable rentals, and the cost to reconstruct the property, as well as the income of the property. Investors, on the other hand, are typically more interested in the potential income and potential return on their investment in the property. The value of any building is based on several principles, including the principle of highest and best use, the principle of supply and demand, and the principle of substitution. The principle of highest and best use states that the property's value is related to that use that's most profitable for that property, or the use that's likely to produce the greatest net return. And that use has to be physically possible, it has to be legal, it has to be legally permissible with the zoning laws, and it has to be financially feasible. For example, a pharmacy like a CVS or a Walgreens might pay more for a great corner property than a gas station or a mini-mart would. And that gas station or mini-mart might pay more for that same site than a McDonald's or Burger King would. And that's all based on what kind of income each can generate from that location. Now, we're looking for the highest and best use that nets the most for the property owner. Now, we just talked about something called zoning yesterday. The second principle, the principle of supply and demand, states that sales prices increase as supply decreases, or as demand increases, which both amount to too few properties for too many buyers. The alternative is that prices decrease if supply increases or demand decreases. So let me put it this way. If there are 5 buyers out there that really want to purchase one particular commercial property, they're going to be likely to bid that price up. This leads to a reduction or a compression in cap rates, which I'm going to explain later in the program. However, if there's only one buyer for a particular type of property in that marketplace or that location, and there are 5 similar properties for sale, there's downward pressure on the price as those property sellers compete for that one buyer in the market. Now that's the principle of supply and demand. The principle of substitution states that the value of a property tends to be set by the cost of acquiring an equally desirable substitute property. In other words, a buyer is unlikely to pay more for a property than it would cost to purchase a similar property. Although every piece of real estate is unique, if there are 2 similar sized buildings on the same block and the same street and one sells for $500,000, what would you pay for the same building next door? So using these principles, an appraiser typically makes a determination of the value by using several methods of comparison with other recently sold commercial or investment properties in the same general area and of the same type as the property that you're selling. In their final report to the lender, they're going to reconcile those 3 different approaches and give different weight to each. The 3 approaches, again, include the market data approach, which we call the sales comparison approach if you're in the residential side. And it's the comparison of the property to other properties of similar size, condition, and use in the same area. Evaluating the property entails adjusting the value of the building by adding or subtracting for size or amenities and for condition in comparison to other recently sold properties in the same market. Some investors use the sales comparison approach or market data approach to try evaluating a property by comparing a price per square foot of office buildings or retail space, or a price per unit for multifamily properties, or a price per room for hotels and hospitality properties. But if a downtown building in Las Cruces, New Mexico is selling for about $100 a square foot, then it's likely that a building that's similar that you're trying to evaluate in the same area is going to sell close to the same range. But it only works if you're comparing apples to apples. So if you're a residential agent and somebody asks you for a price per square foot for a new 4-bedroom colonial, you might be able to give them a range, right? But the actual price per square foot is really based on the quality of construction and the neighborhood. So if you're in a different school district, the prices might be different. If you're evaluating office buildings, for example, you only ever compare with buildings that are in the same area and the same condition, Class A or Class B, so you can ballpark what that building might be worth. And it's true, the same is true for any type of commercial property. If you are comparing the price per room of a hotel, make sure it's the same quality of the hotel in the same market before trying to compare room by room. You can't compare Ritz-Carlton to a Motel 6 because they're not the same animal. The second type of appraisal method is the reconstruction cost less depreciation. And an appraiser uses it to determine value by estimating what the land is worth under that commercial building, and then adding the cost to rebuild that building at current market prices. The appraiser then subtracts the physical depreciation, such as wear and tear and age, and any functional obsolescence, which means that new buildings may have features that older buildings don't. This is often a useful comparison if the building being purchased is relatively new, or to assist a buyer with comparisons when they're considering purchasing an existing commercial building or constructing a new building. And finally, there's the income method. As part of any appraisal, the income approach is still based on similar properties in the same area, but the comparison is strictly by the income generated by the property in comparison to the income generated by similar properties recently sold in the market. So if, for example, an appraiser finds that most properties are selling between 10 and 12 times their net income, then the value of that commercial property probably lies in the same range. So when I say income approach, does that mean we're valuing a property by the cap rate? Or are we talking about cash on cash return? Or what about that gross rent multiplier thing or internal rate of return? Now I'm going to start by outlining the different components of the income equation and step through each of the terms so that you'll know how to talk and walk, or walk and talk, like a commercial investment realtor. And then we'll be able to use those components to understand the different ways of measuring the return on investment. We're going to start by valuing a property by what we call the gross rent multiplier or the gross income multiplier. And then we're going to take it a step further down to cap rate. You've probably heard that term, and that's based on something called the net operating income. Then we're going to drill down to the cash on cash return, and that's what you may actually be making before taxes. And finally, we're going to look at the discounted cash flow formula, and what net present value means and the internal rate of return of an investment property, which is why some people will buy properties that don't look like they make a lot of money because they are going to make a lot of money over time. And that all fits into something called the internal rate of return. And we're also going to look at some other important components of evaluating property, including something called the debt coverage ratio. So let's start with figuring out how much money is really coming in on the property. We're going to call that the gross scheduled income, or GSI. Gross scheduled income is the total income a property could generate if the entire building were rented all the time. If we're talking about a multi-unit investment property, it's going to mean that all the units are rented all the time. If we're talking about an office building, it means every rentable square foot is leased. And this number is computed by adding all of the rents from all occupied units and adding the market rent for any unrented units as well into the equation. Although gross scheduled income could refer to monthly income, it's generally used to describe yearly income. So we multiply it by 12. So for example, if we're looking at a multifamily building and there are 10 units, and each of the units rents for $1,000 a month, that would mean that if you have all units rented all the time, you'd get a gross income of $10,000 a month, or times 12, $120,000 a year. Again, that's your GSI, or your gross scheduled income. And by the way, CCIMs often call this potential gross income, or PGI. There are several terms depending on what organization you're with of how this is referred to. So potential gross income is the same as gross scheduled income. As an example of an office building, and I went too far the wrong way on the slides, but as an example of an office building, if you have, for example, a 12,000 square foot office building where 10,000 square feet is rentable, and by the way, that happens again because there are some spaces that you can't rent. There's elevators, there's a lobby, there might be room for a heating and air conditioning system, and so on. So let's assume that there's 10,000 square feet of rentable space in this 12,000 square foot building, and all of it's rented all the time at $12 per square foot, which really sounds low to some of you and really sounds high to some of you in other areas. For those of you who are new to real estate, by the way, when you hear the price per square foot, when you hear a price per square foot for office or retail or warehouse, it usually means per year, not per month. So again, we multiply $12 times 10,000 square feet, and we get $120,000 per year if it were completely rented and every square foot was rented all year long. But in reality, tenants do leave, and sometimes space sits vacant for a while. And sometimes in order to attract a tenant to your office building or your shopping center, you've got to make some concessions and maybe even give a few months free rent. So it's unlikely during the time somebody owns the building, called a holding period, and I use a lot of terms like this because I want you to get used to them, during a holding period, that building is going to remain 100% occupied 100% of the time. And because of that, if we're going to truly represent our buyers, our investors, the people who are going to be purchasing this property with accurate information, we have to reduce that gross scheduled income, or that potential gross income, by some vacancy factor because we know it's going to happen. And that factor is different for different property types and in different markets across the country and the world. So how do we figure out what kind of vacancy factor to use? Well, there's a lot of ways to determine an appropriate vacancy rate in your area. You could survey surrounding buildings, call the owners or property managers or realtors listing buildings around the property that you're trying to price, and verify the amount of rentable space and the amount of vacancy, and then try and average it. You could try and buy a report on CoStar or from a local chamber of local commercial information exchange like Catalyst or Comrex. Or you could take the last 3 years or the last 5 years, look at the vacancy over those periods of time on the building itself, and figure that if the building's been vacant roughly 5% of the time each year, it'll probably continue to be vacant 5% of the time unless there's something major shifting in the area in the marketplace, like a big economic downturn or an upswing. But again, one of the best methods to ballpark the typical vacancy rate is to call several commercial lenders. Why? Because commercial lenders, when they're underwriting a loan on a building, have standard factors they use based on the property type, the location, and the market conditions. They hire people, they hire appraisers to go out and research the market and study it, and they come up with their own numbers. And sometimes you can get that information by connecting with a couple of commercial lenders. whatever number you determine as the vacancy rate, you've got to take that percentage off the gross scheduled income to come down to a more accurate picture of what a commercial property buyer is likely to receive in rents during the holding period. There's one caveat, by the way. If you talk to a couple of commercial lenders and you find out that the typical vacancy rate in your location is about 7% for this type of building, but for some reason your building has been half empty for the last 5 years, then there's something wrong. I would use 50% as your vacancy rate. But Lauren, you might say, that building could make so much more money if the building were fully leased. Okay, then why is it half empty? I hear that question all the time. There's an issue somewhere, and that issue has to be addressed. In most cases, though, you simply take off the vacancy rate from the gross scheduled income, and that gives you a number we're going to call our effective gross income, or sometimes called just gross income. Your effective gross income is your potential gross income minus vacancy and collection losses. So if we go back to our office building example, we had a gross scheduled income of about $120,000. We figure out after talking to a couple of commercial lenders that the vacancy rate that's typical in the area for this type of property is 7%. So we reduce the income by 7% or $8,400. That gives us an effective gross income of $111,600. This is the number we want to try and come up with our first method of evaluation. This number, our effective gross income, or just gross income, helps us to determine the value of the building in some situations. So if you're pricing office buildings or retail space, you may have to take off that gross income or that effective gross income something else called rent abatements. Now, often, in order to attract a long-term tenant to an office building or a shopping center, the landlord may incentivize the tenant by offering some period of free time, some period of free rent. It might be a month or two. If there are any rent abatement incentives in the market that may apply to the building you're trying to price, you should also reduce your estimated income by what you expect the abatement to be in order to arrive at that effective gross income. So again, at this point in the equation, we have our first number for calculating sort of a value, or at least a comparison for what you might want to pay for a building. As I talked about yesterday, the gross income allows us to compute our first income valuation. Now we're going to call that the gross rent multiplier. Some people call it the gross income multiplier. As I said yesterday, although I strongly recommend you do not ever use this as a valuation method to compare commercial properties, I need to explain it to you because there are many realtors, many investors, and many managers that use the term, so you need to understand it. Now the gross rent multiplier, or GRM, is simply the sales price of a building divided by the gross income. For example, if you're trying to price an apartment complex and you've found 3 other apartment complexes that have sold recently, and you know the gross income of each complex, you can compute a rough gross rent multiplier for that area so that you can ballpark, and I do mean ballpark, the value of the building you're trying to price. So let's do a quick example. Let's say we're trying to price a building in our area. It's a multi-unit building, and we identify 3 comparable apartment complexes that have sold recently. The first one that's on the screen is a 30-unit building. It's got a gross income of $360,000 a year, and it's sold for a little over $3.67 million. Again, to get the gross rent multiplier, we're going to divide the price by the effective gross rent. So we're going to divide that $3.672 million by $360,000, and that gives us a gross rent multiplier of 10.2. There's a second complex we've identified, and that one's 25 units and sold for just a hair under $2.5 million with a gross yearly income of $255,000. So we're going to divide that $2.499 million by $255,000, and on this building we get a gross rent multiplier of 9.8. And so for the third building, we have a bigger building here at 50 units, and it carries a yearly income of $585,000, or nearly $585,000, and it's sold for $6.1425 million. So let's divide that $6.1425 million by $585,000, and that gives us a gross rent multiplier of 10.5. Now you might want to pause at this point and try and calculate these out yourself, but it's a fairly simple calculation. We're going to get into some more complex stuff in a little bit. So if we average these 3 comps, these 3 properties, we find that one is 10.2, one has a gross rent multiplier of 9.8, and the last one is 10.5. The average is 10.17, so that's great. How exactly does that help us value the building we're trying to price, the value of the building we're trying to buy. If we know the gross income of the building we're trying to price, and we know a range of gross rent multipliers for similar buildings in the area, we can do simple division and get a range. So let's say we're trying to sell a building, and we know the income on our building, the gross income is $400,000, and the range of gross rent multipliers in the building in the area for similar buildings is about 9.8 to 10.5. We have a range of values. We multiply 9.8 times 400,000, and we get 3.92 million. We multiply 10.5 times the same number, and we get 4.2 million. So we've got a range, 3.9 to 4.2. It's pretty tight. Based on the average gross rent multiplier of 10.17, that value would likely be 4.068 million. That gives us a value and a range. Now this is an easy calculation, and it only requires the realtor or the investor to know the gross rental income and the sales price or list prices of comparable properties. But again, I hesitate to use it because the number is often incorrect. The issue is that an investor looking for a true return on their investment and a gross rent multiplier is calculated before any expenses are taken off the building. And expenses can vary dramatically from building to building, which is going to affect your bottom line numbers. One apartment building might have the owner paying all the expenses. The next apartment building might have the tenants paying all of them. So this number doesn't really mean a lot. I don't like it. So I try and take it at least the next level of the equation. And what's the next level? It's taking off the operating expenses that the property owner pays to maintain and manage that building, so we can get closer to an actual return on our investment in that building. So what are operating expenses? Operating expenses are those expenses that have to be paid by the owner to operate and maintain the building. And that can include the property taxes, the property insurance, the utilities paid by the owner, not paid by the tenant, maintenance and management of that building. Again, those expenses do not include the principal and interest of your mortgage payment because somebody might be buying that building cash. Somebody might be getting a better rate. We're trying to value this building so we don't ever take into consideration under operating expenses the mortgage payment, the principal and interest of the mortgage payment. These expenses also don't include any tenant paid expenses because they're not paid by the owner. So in the example of a 10-unit office building, if the electric is separated to the individual units and the tenants are paying for that electric usage, the utility cost that the tenants are paying is not part of the operating expenses. However, if there's a common hallway, common bathrooms, and an elevator, that owner or landlord should have a separate electric meter for those electric utility bills, and that might be part of the operating expense. Now again, if you're selling retail or office space, tenants will often pay something called common area maintenance fees, or CAM fees, which help to cover the expenses paid by the owner of the property. If these expenses are reimbursed by the tenants as CAM fees, they're either not part of the operating expenses, or those CAM fees are added back into the gross scheduled income because they're getting that money back from the tenants. Now we'll be discussing that in more detail in our advanced program. Operating expenses have to be accurately determined or estimated in order to accurately price a property for a seller or to assist a buyer in determining the property's investment return. These expenses fall into two categories, fixed expenses and variable expenses, and it's important you understand the difference between them because we're going to need to understand this as we move into leases in the next part of the program. Fixed expenses are those expenses that don't change from year to year, from month to month, regardless of whether or not the property is occupied. For example, you've got to pay property taxes on that building, whether or not anybody's in it. You've got to pay property insurance. These are expenses that might fluctuate from year to year, but they generally remain stable for the entire year. The owner is going to pay those expenses whether or not there's a single tenant in the entire property. Other expenses that may be fixed are snow removal or lawn care or security or pest control. Variable expenses are expenses paid by the owner or landlord that are going to increase or decrease depending on the occupancy of the property. And typically those expenses do fluctuate from month to month. Utility expenses like electric or heat or gas or water or sewer are all typically variable expenses. So if someone is occupying the unit, they are far more likely to turn up the heat or flush the toilets. Contracted services like property management and cleaning might also be variable expenses. Garbage might be fixed or it might be a variable expense depending on whether it's municipal or contracted garbage. Now I am going to mention a third type of expense. It's called a reserve, because at some point in time that roof is going to need to be replaced, the parking lot's got to be repaved, the central air unit, it's looking kind of shabby now, it's going to have to be replaced, and you're going to have to update those bathrooms from the 1970s. So in order to fully account for any expenses that will be incurred in the future, you should start setting up a reserve fund, the landlord or owner should, and start putting away a little bit of money each month and each year to cover those expenses when they come up. As you're calculating your cost of operating that property, a yearly reserve towards maintenance, repairs, and updates should really be included as part of those expenses. Now, here's the truth though. If you are representing an owner and you're trying to sell a property, you probably are going to neglect, let's say, to include an amount for reserves towards building maintenance, repairs, and updates. And the reason you don't do it is because you want to show that return on investment to be the highest number you possibly can to show buyers how much money the building could make. However, if you're on the other side of the transaction, you're representing that buyer or that investor, you're going to estimate a high reserve number when you're attempting to negotiate an offer for the buyers on their behalf, because you want to show the property owner that the property might not be worth as much as he or she wants. And once we have all those operating expenses paid by the building owner, we can calculate one of the most important financial terms on real estate, and that's the net operating income, also known as the NOI, the net operating income. The effective gross income minus the operating expenses leaves us with the net operating income. Now again, this number does not include your debt service. And again, the debt service is a fancy way of saying the principal and interest of the mortgage payment. It doesn't include any tax depreciation. It does not include immediate capital expenditures like putting a new roof on or replacing the facade of a shopping center. Operating expenses are the costs to manage and run the building, and these are costs that recur year after year. Having the net operating income, however, allows us to calculate the cap rate of the building, which is the most often quoted evaluation of any property. The cap rate, or the capitalization rate, is a simple formula used by commercial real estate agents to obtain a rate of return on the buyer's money if the buyer were paying all cash for the property. It's a simple calculation of the net income of the property divided by the sales price. If you want to determine what price to pay for a building, we have to look again at competing buildings that have sold recently. What was their NOI? What was their net operating income? And what was their sales price? Divide the net operating income, or the NOI, by the sales price, and you have a cap rate. Now, I hesitate to say cap rate is an actual return on investment because it really isn't. It's a way to compare properties, but people do see it as that return on investment, so I want to explain it. Now, I'm going to work through an example using cap rate this time. Let's take 3 buildings again. Let's say we're trying to sell this 10-unit apartment building, and we find 3 recent comparable sales that have sold in the market. We do a quick calculation on each. We divide the net operating income by the sales price to find the cap rate of each building. And we find the cap rate is 8 for the first one, 8.2 for the second one, and 8.3 for the third one. Those are all pretty close. The subject property that we're trying to price contains 10 units, and each is rented at $1,000 a month. So our gross scheduled income on this building is $10,000 a month times 12, or $120,000. Now, we spoke with our local lender, and we find out that the average vacancy rate is 7%. So we take that 7% off $120,000, and we come up with an effective gross income of $111,600. We go to our owner, and we get a full list of their operating expenses, and we find out that that owner is paying $24,300 a year between their taxes, their insurance, their electric bill, and the expenses that they pay. And that leaves them an NOI, a net operating income of $87,300 per year. Now we're trying to figure out what this building is worth or what it's going to sell for. So a good realtor might go back to these 3 comps and try and figure out why one might be higher than the other, why one might have gotten an 8% cap rate versus an 8.3. And you might find a situation where there's one number that's really out of alignment. And in that case, we try and figure out what the problem was. It might have been a distress sale, like a foreclosure or short sale, or a seller who had to sell to meet a deadline. Sometimes the building needs a lot of work or is sold to a relative, and sometimes the building is sold to somebody who really, really needs that particular building for some reason and is willing to pay higher than market value, some premium. Sometimes there's an outlier, so sometimes we throw out the outlier to try and understand what the real value of the building is. But we look at these cap rates, and we have a tight range of 8 to 8.3. So we're going to take that $87,300 that we came up with as our NOI, and we're going to divide by the low cap rate, 8%, and we figure at 8%, that building is worth $1.09 million. That's what a likely buyer will pay for it at 8%. At 8.3%, it's going to be, divide that same 87.3 by 0.83, and you get 1.5 million. And by the way, that happens because cap rate and price are inversely related. And I'll go through that in a couple of minutes. But cap rate and price are inversely related. So we've got a range. We know we've got a net operating income of 87.3. We know our comps have cap rates between 8 and 8.3. And so we can come up with a rough value of what that property is likely to sell for. Now, what is cap rate really? It's, again, the net operating income divided by the sales price. But what does that mean? If you took any financial courses in college, you might have heard of the IRV formula, the IRV formula. It means that income equals the rate of return on an investment, R, times the value, V, of that investment. Income equals rate times value. Now, if we move that equation around a little bit with a little bit of algebra, it also means that the rate of return you receive on any investment is equal to the income divided by the value of the investment that you made in the property. So if you have an income, let's say, of $1,000, by the way, I'm sorry, cap rate, as we apply it to this, is the net operating income divided by sales price. The rate is the cap rate, the income is your NOI, and the value is your sales price. That's how we come up with some numbers. So if, for example, you have an income of $1,000 a year on some annuity, and you invested $10,000 in that annuity to get that $1,000 return each year, you find out what rate you're being paid by dividing the $1,000 by the $10,000 you invested, and you find out that you're getting a 10% rate of return. It's a pretty simple calculation. We're going to do the same thing with real estate. If instead you put $100 in a savings account with your bank, and in a year you get back, yes, $1, divide that dollar by $100 that you put into the account, and you'll see that your rate of return is 1%. That means you should have invested in real estate instead. Now, in the world of real estate, as I said earlier, this rate of return is called a cap rate. It's not really a rate of return. It's really a way to compare properties. But the rate of return is called a cap rate. And again, it's calculated by taking the income, or the NOI, and dividing that income by the value invested, or the sales price of the property. So once again, because I want to get this really, really clear, if you've got a net operating income on a property of $25,000 and a sales price of $250,000, your cap rate is 10%. $25,000 divided by $250,000 gives you 10%. Now, a cap rate is probably not the investor's real rate of return, because the cap rate assumes you're paying all cash for the property, and also you're not investing anything in closing costs or improvements. So it's really just a small portion of what the value really is. And by the way, cap rate is also a snapshot in time, because the income might rise or fall over time. So your return rate is only good for now, right now. You ever see Spaceballs? That's happening right now. It's the rate that you're receiving right now for the property, not the rate you're receiving in a year. So that cap rate is what you're getting now. So why in the world do we use it? See, commercial and investment real estate comes in all shapes and sizes. And a simple calculation allows us to compare the returns of properties in one common language. You only really need to know two numbers, the property's price and the net operating income of the property, and now you can create a thumbnail sketch of one building versus another. So let's do one more example. Let's say your client, Peter Parker, wants to buy an investment property, and he wants a cap rate of at least 10% for what he's buying. And he'd also like to change his name to something else. The net income on the property he's considering purchasing is $89,000. So what's the maximum he'd be willing to pay for that property? He wants 10% return, and the income's $89,000. The answer is to simply divide the net income by the required cap rate. I told you that cap rate equals net operating income divided by price. With a little math, a little bit of algebra, you'll see that price equals the net operating income divided by the required cap rate. So $89,000 net operating income divided by a 10% cap rate gives us a maximum offering price of $890,000. Again, a lower cap rate means a higher value. They're inversely related. If we're willing to buy that $89,000 stream of income, but we're willing to take only an 8% return, only an 8% cap rate instead of a 10, then we divide that same $89,000 by 0.08 or by 8%, and we get 1.11 million. Take a look at that again. That change of 2% raises the value of the property by more than $220,000. Investors are going to pay a premium in some areas. New York City is an area where investors pay a premium by purchasing at a lower cap rate. Think of it as a risky investment versus a non-risky investment. If you're investing in U.S. bonds backed by the full faith of the U.S. government, they are supposed to be nearly risk-free. So you're going to buy them at a very low return. However, if you invest in a country where there's a civil war going on, you might want a bit higher return for your risk that you're taking investing your capital because the building might get blown up next week. Buildings work the same way. If you're buying a building that's leased to CVS for the next 25 years, and CVS is covering all expenses, including taxes and insurance and maintenance, so you're effectively just purchasing an income stream, you might be more willing to buy at a lower cap rate than if you're purchasing, let's say, a 1970s strip mall in a coal mining town where the store might become vacant. You'll get a higher cap rate and thus a higher return because there's more risk. Why did people put money into junk bonds? Because the risk was very, very high, but the rate of return was higher if it paid off. And that's how the relationships work. Obviously, the buyers want to sell at a higher cap rate, or want to buy at a higher cap rate, I should say, and the sellers want to sell at a low cap rate because price and cap rate are inversely related. So we've compared properties by gross rent multiplier, and we've compared them by cap rate. The next level is to figure out what kind of actual cash-on-cash return an investor might realize on the purchase. And by the way, cash-on-cash return is the actual cash return an investor receives on the actual cash the investor put into the building. So, if an investor puts $50,000 into a purchase and then receives $5,000 in a cash return on the building after paying the mortgage, he's receiving a cash-on-cash return of 10%. But to figure out this return, we need to do a little bit more math. A cap rate is based on buying a building all cash and doesn't include closing costs. We need to figure out how much total cash an investor is putting into the property, or that initial investment in the property, and how much cash that investor is taking out after making the mortgage payment. So the initial investment is generally just the down payment plus the buyer's closing costs or any other acquisition costs they have, although it could include some property repairs and upgrades. It's the cash the buyer lays out when purchasing and taking possession of the property. A buyer might be putting down 20% on a $400,000 building, which is about $80,000. And they may have additional $20,000 for appraisal, attorney fees, transfer taxes, and so on. If that buyer's not doing any repairs or upgrades, that initial investment is $100,000. Again, that initial investment is your down payment plus your closing costs plus any initial repairs put in right away. So we want to find out what the net cash flow is. We got the cash in. What's the cash out? The net cash flow then is your NOI, your net operating income, minus your mortgage payment, also known as your debt service. So again, let's go back through the formula. Gross scheduled income minus vacancy factor and any rent abatements gives you your effective gross income. The effective gross income minus any owner expenses gives us the net operating income, and subtracting the debt service or the mortgage principal and interest from the net operating income gives us that net cash flow before taxes. In our example, let's set a price to this 10-unit building of $950,000. We're going to pay $950,000 to buy this building. We had a gross scheduled income of 120,000. We had a vacancy rate of 7% that left us an effective gross income of $111,600. We had operating expenses of $24,300, so our NOI is $87,300. The cap rate again is the NOI divided by the sales price. Now we're paying $950,000 for this building. Our NOI is $87,300. So $87,300 divided by $950,000 gives us a 9.2% cap rate. Now let's see how that compares with what we're really earning as an investment return. So let's say the building we're buying, we're putting 20% down, and we've got some heavy closing costs of over 8%. So our initial investment is $190,000 down payment, plus about $78,850 in closing costs because we must be buying in San Francisco. So our cash in is $268,850. That's our cash in. To get our cash on cash return, we need to figure out how much money we're taking out each year. So to get our cash out, we've got to take our NOI and we've got to subtract our mortgage, principal, and interest, our debt service, from that NOI. And our debt service is a sum of 12 mortgage payments. Now, I've done this calculation separately, but if we take that 80% loan to value and we put it in at a 5% mortgage, our 12 monthly payments are $5,015.66 a month, which means it's about $60,200 or $60,188 per year. That is your debt service, your mortgage. So subtract that from your $87,300 and you get a cash out, drum roll please, of just over $27,000. So we take that $27,000 that we just figured out and we're going to divide it by $268,850. Remember, that's the cash we put in. And we get a cash-on-cash return of 10.1%. We're actually making a better return than we saw on the cap rate. So by borrowing money, we're actually making a better return on our money, and we don't have to put out that entire $950,000 in cash. So if you've got $1 million lying around, rather than just buying this one building with a return of just over 9% based on the cap rate, you can buy maybe 4 buildings with the same cash outlay and maybe get better than a 10% return by making money on borrowed money. That's one of the beauties of real estate investment. We call it leverage. And by the way, this is still just in the first year. That return's going to go up over time too. Now, you might be blankly staring at the screen deciding whether or not you want to go back to selling residential real estate. There's a lot of math in this, but you can learn it. Don't worry, a little practicing gets easier. Now I want to take this a step further. That was cash flow before income taxes. We're going to call that CFBT, or cash flow before taxes. You might have a tax liability, or you might receive a tax benefit each year from owning real estate. In order to determine the tax ramifications in the example we're working with, we have to go back to the NOI, back to the net operating income before we took off the debt service, and we have to start with that NOI instead of the net cash flow because the principal portion of the mortgage payment is not tax deductible. I may have to say that a couple of different ways. But when you're trying to figure out your taxable income, we can deduct from the net operating income the interest portion of the payment, but not the principal. And incidentally, what I have on the screen is incorrect. It says minus debt service. It's actually minus the interest portion of the mortgage payment. So again, we have an NOI. Oh, and by the way, I realized I have this on here. We want to figure out what that depreciation is. So let me skip ahead here for a second. And depreciation, by the way, depends on whether you're in the United States or in other countries you're viewing this program. But in the United States, a non-residential investment property can be depreciated over 39 years, and it's based on a schedule put in place by the IRS. Residential property can be depreciated more quickly, giving you an even greater benefit. But we're going to assume a first-year depreciation of just over 2.5% for this example we're doing, or 2.461% to be precise, which leads me to disclose that I am neither an accountant nor an attorney, so you must always seek guidance from professionals when advising a client. Now, each year, you're going to be able to write off a portion of that building, which is great. The bad news is we're going to have to figure in a recapture of some of that depreciation at the time we sell the building. And we'll talk about that in a minute. And that's one of the reasons you should invest just a little bit in a software program to make this happen. So 2.461% of the purchase is $23,379.50. So we add that to the interest portion of our debt service, the interest portion of our payment of $37,484, and we've got a total write-off next year against the building of almost $61,000. So let's go back and take our NOI of $87,300. We're going to deduct this roughly $60,800, and we get a taxable income of $26,436.10. I know that's a little complicated, but how much are we actually going to pay in income taxes off this income of $26,400? Well, that really depends on your tax bracket. But if we'll say you're in the 33% tax bracket, you have a taxable income of $26,436. You're going to owe the IRS about $8,700. So that brings your net cash flow after taxes to $17,712. You can pause this and go through it briefly. If we take that number, we've taken off the taxes we had to pay. If we take that number and we divide that by our initial investment of $268,850, if you remember that number back from 5 or 6 slides ago, you're going to come up with a cash-on-cash return of 6.6% after taxes. Still a real decent return on your money and a whole lot better than you would have made by sticking your money in a savings account in your bank. But wait, you also get the benefit of paying down the mortgage on the property. You get the benefit of building up equity and hopefully receiving the benefit of rising rental rates and rising building value, which you're going to have to take into consideration as well. Lauren, you might be saying, I sold residential real estate for the last 10 years and I still don't understand all the FHA rules. Do I really need to do this for every single client? Well, probably not. Many clients do their own calculations and are really only interested in the cap rate. But that's not a true reflection of what they're making on their investment, is it? A cash-on-cash return is closer to an accurate picture. And there's some great software programs available that help you to put these numbers together. And we're going to go through some of those in a little bit. But I want you to understand that if you can explain to a client that they might be making a 10% return cash on cash instead of an 8% cap and a 15% internal rate of return, it makes a whole lot more sense for that investor to put money into real estate. And we're going to talk about that as well. You need to understand where these numbers come from and how they relate in order to accurately advise your clients. But we're not done yet. For some of our clients, particularly firms or institutions, we're going to be projecting cash flows over a period of time, estimating annual returns going forward and estimating the current value based on that longer-term projection to account for rising property values and rising income and expenses, and that's what we call the time value of money. Remember that a cap rate is just a snapshot in time. What investors really want to know is what is their real return on their investment over some holding period like 10 or 20 years. How much are they going to make on that period of time? So let me explain why this is important. We talked earlier about investing $10,000 in an annuity and getting $1,000 back. That's fine. That gives us a 10% return in the first year. But let's say you invest that $10,000 into buying some sort of annuity that pays you $1,000 a year back for 10 years. But at the end of that 10-year period, you get some higher amount back than the $10,000 you initially invested. Let's say you get $15,000 back in addition to $1,000 a year for the next 10 years. So your return is not your cap rate. It's not 10%. It's a lot greater than that. In real estate, what you're really buying is a series of future cash flows. If you decide to purchase and hold a building for 10 years, you may get that $1,000 each year for 10 years. And the building may be worth more than you paid for it when you sell it in 10 years. But you can't just add up all those cash flows and divide by your initial investment in order to understand the return. And that's because there's something called the time value of money. You've probably heard this analogy before. But let's say you loan someone $100 today, and they give you that $100 back in 3 years. Did you lose anything? Well, you got your $100 back. You gave them $100, you got $100 back. But inflation has eroded some of the value of that $100. What could you buy for $100 today that won't necessarily be the same as what you can buy with that same $100 in 3 years because of inflation? because maybe that $100 is only worth $94 in 3 years. And additionally, you've lost the use of that money for 3 years. You could have purchased something with it, or more importantly, you could have invested it. So if you took the money and put it into an investment vehicle that compounded over that 3-year period, how much would you have made? Now the chart on the screen shows how quickly that $100 would grow at a 2% return or a 5% return, or look at an 8% return, compounding. And how much the compounded value of that $100 changes with rate is significant. And because of compounding, this is not a straight line, is it? And by the way, in a few minutes, we'll talk about discounting the future benefit, that future return back to today's dollars. Because it's not a straight line, we can't simply divide your return by the number of years we're holding an investment to figure out how much we earned each year during the holding period. It doesn't work. We need to do some additional math to figure out what the value was of keeping that $100 in that investment for 5 or 10 years, or keeping our money in real estate for, in a project for that 10-year holding period. So in order to really understand the investment our clients are making and understand the return the building or property is generating, we've got to project the income and expenses for the holding period and then discount those future benefits we're going to receive, that future income stream, back to what it's worth today. So we need to create a multi-year cash flow. And to create that multi-year cash flow, we need to estimate how long the investor, the buyer, is going to hold that property for, and how much the investor is going to get back in 10 years or 20 years or 5 years when they sell the building. A buyer might have a predetermined period of time he or she wants to own a property, and each year of that expected holding period, that property generates an annual cash flow. In addition, at the end of the anticipated ownership period, the investor sells the property and generates a property sale cash flow, which we're going to call a reversion. There are 5 factors necessary to create a multi-year cash flow analysis, or a forecast. And there is a 6th factor we're going to need if we're going to discount the value back to today's dollars. First one's on the screen. It's called the holding period. You've got to figure out how long the buyer's probably going to hold it. And then we've got to figure out what's the initial investment. How much is the buyer putting into the project between down payment and closing costs? And is the buyer putting any money into immediate renovations or upgrades? How much are they investing up front? Then we need to calculate the annual cash flows for the current year. How much is the building earning today, right now? Then we're going to have to project that out. So we need to estimate the rate of change of the income of the property and of the expenses. Is that going to change? Is it going to grow with inflation? Will income and expenses grow at the same rate? We're going to have to take an educated guess. And then we're going to have to estimate what that property is going to sell for at the end of the holding period so that we can calculate the sales proceeds to figure that into our total cash flow. And I'm going to show you how to do that. And finally, the 6th factor, if we're not just evaluating the income stream and the growth in equity, but we'd like to figure out the value to us today for that income stream over that holding period, over that 10 years or whatever it is, we need to decide what discount rate we're going to use to discount that cash flow back to today's dollars. In other words, what rate should we use to discount our cash flows to the present day? Remember that time value of money? A dollar invested in 10 years is not nearly as valuable as a dollar invested today. Once we discount all those cash flows back, we come up with one number that's our value to a client today, and we call that the net present value. And that allows us to calculate something called the internal rate of return. So let's go back to our example. And this is just an Excel spreadsheet you're seeing on the screen. I'm going to show you how to use some other software in a little bit. But we'll use the example of $950,000 purchase and start building a multi-year cash flow. So we had already calculated the first year's income. We had an initial investment of $268,850 in year 0. That's all the way in the top left-hand side of the screen. I've added a column for year 0 to reflect that we had a negative cash flow of that amount because we stuck the money in. Our first year starts with a gross income of $120,000, which generates a net operating income, if you follow that line down, to $87,300 after operating expenses and a net cash flow after debt service, but before taxes of just over $27,000. That's basically the calculation we've already done. So how do we take that and we project it forward? Well, unfortunately, there is no crystal ball. That's not going to tell you what's going to happen in any particular type of property or any particular marketplace. You're going to have to judge the likelihood of potential increases or decreases. And if we want realistic numbers, maybe we want to ask ourselves, As we look at this building, are the rents at current market rent, or are they high or low for the market? Do you expect rents to remain stable in the future? And are there any pending changes in zoning or in employment locally that might affect your local market rates? Are competing properties in the market better or worse condition than the subject? And will that condition impact the rental of any vacant units? Does the subject need significant repairs, which will impact the rents going forward? And are there any major changes occurring in the neighborhood which could affect the property's rental value or desirability? Are there any tax changes or significant utility changes expected which would affect the income stream? Now, once you understand or have an understanding of the marketplace and the potential changes, you can begin to estimate the future income and expenses. Again, although there are brilliant statisticians in the world who make predictions regularly, there's no magic to estimating future income and expenses. You need to determine a realistic growth factor or appreciation for income and expenses, or a decline if you think the market's going to go down. Another method to estimate an acceptable appreciation factor is to determine the increase in income and expenses over the past 3 or 4 or 5 years and average those increases to find an appreciation factor. Now, that doesn't always work because there are ups and downs in every commercial real estate cycle. A deeper analysis of the market might be found in contacting your local economic development organization or your local appraisers and obtain their view of likely increases in market rents and expenses. Now, in this example, for simplicity, I'm going to claim that there's an inflation factor of about 2.5%. So that's what I'm going to use. I'm going to say I think they're going to go up by 2.5% a year. Both the income and the expenses are each going to go up 2.5% per year. And I don't think that's going to be too far off from most models. So we're going to use either Excel or RealNex, R-E-A-L-N-E-X, which we'll talk about in a couple of minutes, formerly known as REIWise, or any projection software, and simply apply that increase to your income and your expenses over the holding period. In this case, a 2.5% increase each year actually raises our effective gross income on the building from $111,600 in the first year, if you can follow the column over, to over $139,000 in year 10. That's just a 2.5% increase. Now, if you're projecting income over 10 years, you're also going to have to account in the expense column for any large expenses or capital improvements that need to be made during the holding period. In this example, I'm not worried because remember, we put in a reserve fund as part of our expenses. So we're adding money to that every year to try and cover any big things that come up. But some investors and realtors tell me that we shouldn't do it that way, and instead we should try and figure out when the roof's going to go bad and when we need to put in that parking lot, and we should take that capital expense off in that given year. So you've got to ask yourself, are there any areas of the property that are likely to need major repairs or renovations in the next few years or during the holding period? And in that year we might plug in $20,000 as an expense in year 8 toward a roof, which I did not do in this example because we just covered everything. By the way, in a more advanced analysis, we're actually going to plug in the lease expirations for each office or retail tenant and then calculate the likelihood the tenant will renew, factor that into our analysis, and figure out how much in tenant improvements we may have to make to keep tenants as their leases expire. We plug all that into a more robust analysis if we need to do that for some of our bigger clients. For example, if an office building has 5 tenants and 2 leases expire during the next 10 years during the holding period, how likely are they to renew? Maybe a 70% chance? And if they do renew, how much investment might the landlord make in tenant space refurbishes to keep them? And are there any commissions the landlord has to pay on renewal? Of course, this is an introductory workshop, and there's software that makes that fairly easy, and we're going to talk about that shortly. But I don't want your head to hurt. I want you to just understand that there are other components that we're kind of setting aside at the moment. So in this example, you can see how we grew the income and the expenses over time. Since the income is greater than the expenses, we have a better and better return each year of the projection. The final year of this final part of this multi-year cash flow is to figure out what we're going to sell the property for at the end of year 10. Some realtors simply grow the value of the building at the same rate they grow the income and expenses, 2.5% compounded, and at the end the building's worth more. I prefer not to do it that way. My preference is to figure out what the NOI, the net operating income, is probably going to be in year 10, and then divide it by what I assume the cap rate is going to be at that point in time. That gives us a price that it's likely to sell at, because that's what investors pay based on a cap rate. So remember that either way of coming up with a sales figure is honestly a guess. But in this case, the NOI in year 10 is just over 109,000. So we're going to divide that NOI by an assumed cap rate of, let's say, 10%. It's higher than the one we have going in. But an assumed cap rate of 10%, and we get a sales price of $1.09 million. Now remember, we only paid $950,000 for the building 10 years earlier. Now on the other hand, if the cap rate is still 8% in year 10 instead of 10%, we'd have a significantly higher value of $1.36 million for that building. That buyer or that seller could be making a lot of money if the cap rate is still the same. I'm trying to be conservative in this estimate. Now, you may want to make it look as great as you possibly can when you're doing this pro forma or this report for your clients. To get our outgoing cash flow or our reversion cash flow, we need to deduct the amount that's still owed on the mortgage. And there is software to do that as well. But if I do a quick amortization calculation, it shows that in year 10, we still owe $473,000. It's a 20-year mortgage. We still owe $473,000 on that $950,000 building that we borrowed 80% on. So if we do sell the building at $1.09 million, that leaves us with about $617,000 net cash to us in the sale. And of course, there are probably closing costs to sell, and you should estimate and take those off as well to get an accurate picture. I'm trying to give you a flavor of what happens. Now, we can do the same thing in only one step by using software packages like RealNext, REALNEX, which again I'm going to talk about in a couple of minutes. It's going to calculate the reversion or sales proceeds at any year during the holding period by clicking a button. And this final chart gives us a great overview. This is a report from RealNext. It gives us a great overview of what we anticipate happening in the property over the next decade. And it's a great way to show an investor the potential income as their rents increase and as the loan is paid down and as the value of the building continues to increase. I'm also going to use this chart to estimate what we call net present value and then calculate the IRR, the internal rate of return of the property, in a couple of minutes. And again, net present value is taking a series of cash flows and with a little math, okay, it looks like a lot of math, computes what that's worth to you today based on what rate your client feels that compounding should be discounted back at. And we call that a discount rate. Now I'm going to make your head hurt a little bit more here. We all understand the idea of compounding, right? If we put $1,000 in a money market with a 10% return, okay, I'm being a little optimistic here. Hey, maybe things will go better. But at a 10% return in 5 years, that $1,000 investment is going to be a little over $1,600 because of the beauty of compounding. Now, the idea of a discount rate is kind of the inverse of growing your investment or compounding in reverse. What we're trying to determine is how much less that future money is worth in today's dollars and how much an investor would have made using another investment vehicle. We're trying to compare this with other investment vehicles for your client. We also call this the investor's required rate of return. What is that series of cash flows worth me today if I expect a return of 8% in some other venue, or 10%? So if we're compounding our investment, it grows over time. If we're discounting it backwards, we're reversing that compounding to see how much we'd have to invest today to get that ultimate return that we're looking for. So if you assume a discount rate of 10%, then the value of receiving $1,000 in 1 year is worth $909.10 or $909.09 today. If you invest $909.09 today at a 10% rate of return, you're going to receive $1,000 in 1 year. So we use a formula to figure out backward what that's worth, or we use software to do that. And we're going to be talking about a few different cash flow methods in a couple of minutes, particularly under leases. So before we get started, what should you pick as your appropriate discount rate? Because the software is going to ask you what discount rate you should use. And there are a wide variety of methods used to determine discount rates, but in most cases, the calculations seem to be more art than science. I can tell you that large firms often use a weighted average cost of capital after tax, but I don't want to spend the next hour trying to explain that. Others may tell you that a discount rate is really a reflection of the opportunity cost of this investment relative to other investments. If you've got $250,000 to invest, What are the returns on other investments with similar risk profiles? Now I want to simplify the process. You can look online for what other investors are considering the discount rate to be at the present time. You might subscribe to realtyrates.com and see what their investor surveys estimate an appropriate discount rate to be in your location. Remember that a discount rate is going to be different for different property types. It's going to be different for multifamily versus office versus retail, and it's different for different areas of the country. New York City is going to have a different level of discount rate than St. Louis, Wichita, or Prague. So you can look at realtyrates.com, or another source I often check out is pricewaterhousecooper.com, pwc.com. They've got some comprehensive investor surveys that help you to gauge the level of thinking on risk and rates. Again, discount rates vary from property type to property type and location to location, and it's appropriate to adjust the assumed discount rate to compensate for the perceived risk, the opportunity cost, or other factors. If you're going to put your money in a CD, there's not a whole lot of risk to you, so you don't expect a real high rate of return. If you're putting your money into real estate, you expect a better return than sticking it in a CD. So let's go back to our $950,000 example, and let's pick a number out of the PricewaterhouseCoopers chart for a Midwestern office building. Our required rate of return, our discount rate, is 8%. The way that's calculated might make your head hurt. This is the formula. Hold on, let me see if I can pull this up. This is the formula for what each year's income is worth in today's dollar when applying the discount rate to the equation on the screen. It's the sum of each cash flow divided by 1 plus the expected discount rate to the power of the year. I told you it might make your head hurt. If you look at the left-hand side, for each year you get a cash flow, well, let me start with CF0. On the far left-hand side, the second set, CF0 is a negative cash flow because that's what you put in as your initial investment. So you start with a negative return. Year 1, you get a cash flow back in your first year. So you take that cash flow in year 1, and if you expect an 8% return, then you divide that cash flow by 1.08, and it's the first year or so, it's to the first power. Your cash flow in year 2, you divide by 1 plus 0.08 to the second power, and so on. And we add all that up, and then we take that long list and we discount it back. And the net present value, by the way, is when we sum up all those future values backward, we get a number that tells us what we're willing to pay today to receive that expected future benefit. Now, let's say, for example, let's see if I have one here. Let's say, for example, you want to value a cash flow you're going to receive, but it's just one cash flow and it's going to come to you in year 3. And let's say you expect that if you had the money today, you'd be receiving at least 8% per year in benefit from using that money. So the cash flow you receive is in year 3, and the discount rate is 8%. So you're going to divide that cash flow by 1.08 to the third power, to the year that you're dividing it by. And by the way, I'm showing you these so you understand the theory, but you're probably never going to actually calculate this directly. You're going to use Excel or you're going to use another software program to make it happen. Now here's another way to look at the same equation. We call this a T-bar. In year 0, we put into the transaction your initial investment. Each year you get back a payment, and in the final year you get back the payment plus whatever proceeds you get from the sale, that future value. We're trying to take that stream of income and figure out what it's worth to us today based on what our expectation is of returns. So let's go back to our example. Whether we're plugging this into a T-bar or our equation, we want to find out the value for the entire stream of income over a 10-year holding period. So we plug in all these numbers, and notice the very first number is negative. Again, this is because in year 0, we're sticking money in. We're investing the down payment and the closing costs, so we're putting money in, so we actually have a negative cash flow right away. During the first year, we make money. We get cash flow back out. We're going to discount that by 1.08 to the first power, and so on and so forth, until you get that last 10th year when you actually sell the building, and you get the last year's income plus all that money and divide it by 1.08 to the 10th power. Now, before your head hurts too much, this is all done by software. You can do this in Excel or you can do it in a financial analysis package, but you'll likely never have to do this calculation. I want to take it one step further. I want to introduce you to the concept of the internal rate of return, or the IRR. because you're going to hear about this. This is a way to calculate the discount rate, which yields a net present value of 0. It's the rate earned on each dollar invested for the period it's invested. Again, it's the rate of return each dollar invested in the property receives over the holding period. And it answers the question, what rate will the investor achieve given a stream of cash flows? It takes into account all the cash flows you get over time, not just the first year. And it's used to compare investments by pretending that all the returns are kept in the investment rather than you taking money out. And again, the IRR is something you're going to be asked about by institutional investors, and we're going to use software to do this. So in Excel, you can calculate the IRR by simply typing equals IRR, and then put a parenthesis around each of the cash flows from year 0 when you stuck money in to year 10 when you sold the building. And the IRR comes back at 18.26%. That's incredible. But remember, this is based on leaving all the cash in the investment, but it provides a way to compare one investment vehicle to another. So building a full cash flow model and calculating an internal rate of return is called a discounted cash flow analysis, or a DCF. So when you're attending conventions and someone comes up to you and asks about one of your listings and wants to know if you did a DCF on it, that's what they're talking about. It's a projection over a period of time. And there's one other reason to consider an internal rate of return in lieu of using a cap rate. It helps us to answer the simple question as to why some investors buy properties at break even or even sometimes at a loss. Why purchase a real estate investment at a 1% return when you can do better purchasing bonds and you don't have all the risk and they're easier to sell if you need cash out? It's because investors look for properties that have very strong growth rates. If an investor feels that they're buying at a very low cap rate today, but they can attain a high IRR, they might be willing to buy for a future benefit. So if we go back to our example, this building has a gross rent multiplier of 8.5, doesn't mean a whole lot. It's got a cap rate of almost 9.2%. It's got a cash-on-cash return of almost 10.1%. But it's got an internal rate of return of over 18%. That's amazing. Now I'm going to introduce one other concept in this section, one other type of calculation. It's called debt coverage ratio, or DCR, or DSCR, depending on who you're talking to. It's a term that's more often used by lenders or banks rather than by investors, but it's a calculation you need to be familiar with because it's a threshold that lenders or banks use that you're likely to need when you're putting together a commercial offer or a commercial sale. And the debt coverage ratio, or DCR or DSCR, is equal to the net operating income, the NOI, divided by the debt service. So if in our example, our investor has an NOI in the building of $130,000 and his annual mortgage payments are $100,000, we divide our NOI by the mortgage payment by the debt service, and we get a DCR of 1.3. What does that mean? It means that for every dollar of debt against the building, they have $1.30 of income. So even if they lose a certain percentage of the tenants, they can still cover that mortgage. That's why it's important. What if you have a $100,000 net operating income, but your payment's $100,000 in debt service? Well, you might have trouble talking a lender into doing the deal. But 100,000 divided by 100,000 is 1. It's a 1-to-1 ratio, and it's what we call our BEP, or our break-even point. And obviously, investors typically want to buy above the break-even point. So your bank or lender is going to set a DCR, or a ratio, based on the investor, on the type of property, how strong the investor is, on the type of property, how less risky or risky that property is, and the lender's perceived risk. A lender may require only a DCR of 1.1 or 10% greater than the net operating income, or net operating income greater than the debt service, or they might require 1.2 or 1.4, depending on the risks. The lender wants to make sure that the property can sustain its debt all by itself, whether or not the owner continues to own the property. And in the case of our example, the NOI, or the net operating income, of this building we've been working on for all day is $87,300. Our debt service is 5% for 20 years, and that's $60,187 if you remember. So the debt coverage ratio is 87.3 divided by 60,187, which comes in at 1.45, or the Income is $1.45 for every dollar of debt. That's a pretty strong ratio, and it's probably going to be accepted by any lender. But let's say the income's only $70,000 and your mortgage payments are about $60,000. Our DCR would be $70,000 divided by $60,000, or 1.16. So if you're going to a commercial lender and they require a DCR of at least 1.25, even if your investor is fine with the return on investment because he or she anticipates a really strong growth rate in Manhattan or San Francisco or Miami, the lender's not going to lend the money. So the buyer has two choices because it doesn't hit the threshold. So the buyer's got two choices. He can either increase his equity position in the property, in other words, put more money down so he's borrowing less, which will raise the debt coverage ratio, or he can offer less money for the property. He can buy it at a lower price to where the DCR is in line with the bank's requirements. Now, one other possibility is to shop other lenders and find one with reduced requirements. There is variability between lenders in these ratios. Now, you understand the basics of how to do these calculations, so what kind of software should you use to do all this math? Well, I do have a few friends who actually use HP calculators and do it by hand. I wouldn't recommend that. There are a few apps for your Droid or your iPhone that work pretty well too. You can do what we did here today, which is build a model in Excel. Many of the best off-the-shelf investment analysis programs are actually templates based in Excel. And Excel has powerful features like IRR and net present value built in and other metrics. Again, the examples we've done today have all been Excel. But as you become more successful in commercial real estate, you'll want to use a more complex software program that'll do everything for you. And I'm going to introduce a product that is pretty affordable and is exceptional. And unfortunately, we'll have to talk to Randy about the current cost because I'm not positive of it. It's normally $540 a year, but Century 21 pays most of the cost. So you might end up spending $100 or $200 a year to have this software, and I can't recommend it enough. It was called REI Wise. That's what you're seeing at the top of the screen. They have changed the name to RealNext, RealNex. But if you go to reiwise.com, RealNext will actually come up. It's an unbelievable deal. Everybody, every place else is paying $540 for it. So it's analysis software that projects income and value. It includes comprehensive tools for lease analysis, resale valuation, cash flow analysis. It prints listing presentations for you and does a full range of sensitivity analysis tools, which you may not ever even have to do, but it's got some of the best client reports you'll ever see, and I don't get paid by them. So rather than building your own Excel models, you'll find software like this allows you to easily enter data on the property, analyze the data, and spit out a presentation. This slide shows the same thing that we created in Excel that took us 20 minutes or 30 minutes. This actually took 5. It follows the cash flow formula to gross scheduled income, reduced by a vacancy rate, rent abatements and other factors. Next, it accounts for the total operating expenses, spits out the NOI, accounts for the loan payment, and it calculates the loan payment for you. You don't have to do it. And the capital expenses in order to give you a net cash flow, and it'll calculate the cash on cash return for you without you doing anything but sticking in the initial numbers. Software's got a great variety of projections. I know this sounds like a sales pitch. It is. And you can even analyze the price of the property based on a variety of different variables. You can do a sensitivity analysis as to how to difference in vacancy rate or expense projections might change your bottom line. As you can use this software to design some beautiful reports that can be used for either a listing presentation or an investor package. I mean, certainly shop all the software packages available and see what's right for you. But this does some great stuff. This is a sensitivity analysis. What if there's a higher vacancy rate than we expect? What if interest rates rise? What if this? What if that? It'll calculate it all out for you. And this is some of the reports that it'll create. You can import photos into it. You can even import comparables to build a market analysis right into the software. And it'll print out a 10-page, a 50-page, a 150-page report if you want it to, with everything you can possibly need about a property. And this is more of the reports that shows what the comps are, and so on. Now, there is also a deal that Century 21 has with the Analyst Pro, and that is on your desktop. It's also on your cell phone. I have to confess, I don't know the entire deal on the Analyst Pro, but I understand it's a great deal, and it's easily accessible from your handheld devices. So before I start talking about investment analysis and move on to the next section, which is going to be leases, let's go back through the different forms of income evaluation. We started today by talking about gross rent multiplier, or GRM, and it's the price over the gross rental income, and it's primarily used by multifamily brokers and owners. We don't use it in office or retail properties because the lease structures are too complicated and the expenses are more complicated. And in section 4, we're going to go into that, and it can be a very inaccurate measure of value. Then we went to cap rate, and cap rate is the net operating income divided by the price, and it's the most often quoted rate of return. It's not really a rate of return, but that's what they quote it as. And the benefits of using this form of evaluating a property is that it takes into account both income and expenses, and it provides an easy way to compare building to building as if a buyer were purchasing them without a mortgage or without leverage. It's an apples to apples comparison of building returns after operating expenses. Now, the only major shortcoming of this type of evaluation is that it doesn't factor in financing of the building, so it's not really a return that the investor is receiving after they purchase the building. So we go to cash on cash return, and that's the yield or the net cash flow after you've made your mortgage payment divided by your initial investment, which is your down payment and your closing costs. So this is your real return before taxes and before depreciation, and it's a great indicator of return when you're trying to figure out how much you would make on this investment versus putting the same money into the stock market or bonds. A cash on cash return evaluation also allows you to test different amounts financed in order to figure your best return with leverage. And then your internal rate of return is the most complicated, most complex method of evaluation. Every year you've got a cash flow, and those cash flows need to be discounted back to today's dollars based on something we call a discount rate. In order to compare one investment vehicle to another, we set the net present value to 0, and we run a calculation using Excel or REI Wise or some other software program. Now remember that your first year has to include the outlay of cash to buy the building, and the last year has to include your net proceeds after you pay back the mortgage. And to make this work, you've got to accurately predict what the property is going to sell for at the end of the holding period, at the end of 10 years or whatever that holding period is. And you have to accurately predict the amount that's still owed on the building and the cost to sell that building at the time you sell it. You've also got to predict inflation of your income and your expenses, and you've got to predict capital expenditures. So if we expect that we have to renovate 3 commercial units in year 5 because we've got tenants leaving, we've got to estimate the cost of those renovations. And if we need to replace the roof in year 6, we've got to estimate that as well. We've got to stick it into our calculation and take that off. When I'm at events, some agents come up and tell me that they've never done an IRR calculation and then they never will. And they may be right. That's perfectly fine. But my students in New York and Boston and Washington that work for big firms are required to do IRR calculations for their clients on a daily basis. And you want to compete against those. If you're going to work with an institutional investor or a developer, and by the way, there are institutional investors in every metro area in the country, but this is used by institutional investors. Now, the downside of this estimate of return is that you're assuming the investor is putting all their money back into the property or project, which is almost never true. But it does allow a comparison between various investment vehicles. And then the last one we talked about today in this session was the debt service coverage ratio. And in the final analysis, this is more of a bank or lender term, but it allows us to know how much a lender will finance on a building. And it's critical because the lender's not going to go above a certain ratio. As a realtor or an investor, you need to understand where that number comes from in order to calculate what amount you need to invest in the property to make that DCR work. And the DCR, again, is the net operating income divided by your mortgage payment, by that debt service.